Welcome to Financial Revelations. I am David Safransky, your host this week, and I'm your host every week, so that's not going to change most likely. You can always catch us on WCRF. It's 103.3 if you're in Cleveland, Thursday mornings, 8 o'clock. And if you're not in Cleveland, you can get the Moody Radio app at the App Store if you have an iPhone or be honest, I don't know what people do who don't have an iPhone. So wherever you get your apps at, you could get Moody Radio's app, and you can listen to us live on the app. That's how my wife does it. At least she says she listens. I don't know if that's true or not. No, it is. It is true. So catch us at FI Revelations on Twitter. You can email Joshua at joshua@epsf.com any questions that you have. And today we're going to talk about two things. I have a question that I want to go over that I got on the radio today, and I didn't know the answer, so I did a little bit of research. It wasn't very hard, but I want to go over that question that we got, and I want to talk about what the Fed is dealing with right now, and what I think is going to be most likely the conversation coming in the end of September, October, November timeframe, and that is stagflation. Stagflation is really two words put together by economists that mean stagnation, and they're talking about the economy. And in a way, that's what we have right now. And a lot of it is COVID induced. I think the underlying economy is actually pretty strong if we could get COVID out of the way, but we're going to live with it for a while longer. And what's happening is you get like a bloom of COVID someplace, and then the numbers drop and it pops up some other place, and then the numbers drop and it pops up some other place. And where we saw that is we saw it in China, where they closed a big city and one of their second largest port down, nothing in, nothing out. And then you saw it in the United States, and a lot of things closed down and people were going back to mask mandates and mandating vaccines, which I'm totally against. I think if I have the vaccine, and I got the vaccine because I travel and I wanted to get it. But if you don't want to get it, I don't totally understand that, but you have your reasons. I'm not going to judge it. But if you don't want to get it, I think you should be able to not get it. This is not a disease that kills most people. And by not getting it, you're not hurting me. I have the vaccine. So and by the way, I think every living person practically is going to get the virus. I do. I think that this is a virus. We've never cured a virus before. If we do cure a virus, we could have started with the common cold. That's a virus. That's a version of a COVID virus, the common cold. And we've never done that. I just don't think we have a cure. What we're doing right now is more of a therapeutic, and I'm okay with that. That doesn't bother me. It's not really a vaccine because you could still get it. The flu vaccine, not really a vaccine because you got to get it every single year, and they don't always get it right. So I think everybody's going to get the virus most likely. Some people, they're not even going to know. And apparently, if you have the vaccine, your experience is way better. You're less likely to get hospitalized. I'd recommend getting it, but I understand if you don't want to. But what's happening is we're getting these outbreaks in different places, different geographies, different countries. England just went through a really bad one because they did away with all of their mask mandates, all of their COVID vaccine mandates. They just did away with them. And they did have an outbreak right after that, and the numbers leveled off. And I think they're coming to the realization that people are going to get the virus, and that's what's going to happen. But as that happens, we're seeing supply chain disruptions, and we're seeing economic stagnation. That's one of the things that the Fed is going to have to fight. The other thing that they're going to have to fight, and this is very real, and it's inflation. I want to believe that the Fed is correct when they say it's temporary and transitory, because the Fed really wants about 2% inflation on an annual basis. And why do we need inflation? I get this question all the time. Why is the Fed so focused on creating a little bit of inflation? And the answer is way simpler than what you would think, because the alternative to inflation is deflation, and that is way worse. Deflation is you buy a house or an asset here, and it deflates in value, but you still owe here. And whether that's a house or a car or anything that you could think of, if it's worth less 3 years out, it deflated in value, you're not going to sell it, and the economy kind of grinds to a halt. So their solution to this problem of deflation is to create just a little inflation. And you think about, like, if you own a house and 10 years from now you go to sell it, some of it's going to be increase in value, that hopefully, and some of it's going to be inflated value. And that's what gets people to sell their house. When they say, oh my gosh, I bought this for 200, now it's worth 325. It's a great time to sell, and we can upgrade our house. And so that little bit of inflation is good. But right now we have 6% inflation. That is not good. And I'm not worried yet, but I am taking notice. I'm going to be honest. I'm taking notice of what's going on. And I want to believe that the inflation that the Fed is talking about and that we have is temporary. But if it lasts for 3 or 4 years, man, it's just inflation. We just have inflation. And I'm a little concerned that the Fed is going to be fighting this stagnation battle or stagflation battle. And see, the battle to fight these two, to fight stagflation and to fight inflation, they happen to be totally different. They're on opposite sides of the pole. So stagnation, what you would do if the economy was floundering and slowing down, you'd loosen the money supply. You'd lower rates. The Fed has a lot of tools to use. It's not just rates. They could lower the Fed reserve requirement that banks have, so banks could be more loaned out. They could do a lot of things to increase the money supply and get the economy to grow. But if you have inflation, the thing to do, the thing that the Fed wants to do, is to slow money down. So they raise interest rates. They raise the Fed reserve requirement. Again, they have a lot of tools, just a couple. But the battles that they're fighting are diametrically opposed. So when you have stagflation, the Fed has to pick an evil to fight. Which one are we going to fight? My guess is that they would fight inflation, because once that train gets rolling, it is really hard to stop. If you remember Paul Volcker, he was the Fed chairman under Reagan. They came in interest rates, a home loan was 17, 19, 20% at times. And he was public enemy number one because he was the one doing that. Because we had such high inflation, we had to slow down the economy. And he just went all out, threw in the kitchen sink against inflation. If the Fed, now we're not there yet. I don't think we're getting there. But if the Fed is going to fight one of these battles, I think they're fighting inflation. They're going to slow the economy down. And that's going to hurt. You know who it hurts the worst is people on the lower end of the economic scale. That's who it hurts the worst. Also, inflation hurts them the worst also, because right now inflation is outpacing wages. So if you're wealthy, it doesn't matter. You're still doing everything you always did. But if you're middle class or at the lower end of the socioeconomic scale, there's just things you cannot do. You're putting food back on the shelves because it's too expensive. Your dollars only go so far. And if wages are growing at 3% and inflation's growing at 6%, you're losing money every year. So it's very important to fight inflation. We cannot let it get a foothold. And I think those are the conversations that we're going to have in the next couple of months. I don't know that it's going to happen, but we are going to be talking about it. And I want you to know what's going on. And that's one of the reasons why I have a little bit more cash in portfolios right now than average, is because I think the Fed is going to talk about tapering bond purchases, market reaction. And it's not to the positive. It's going to be to the negative, because that's the precursor to a rate hike at some point in the future. And everybody in the market knows this, and they have to stop buying bonds before they can raise rates, when it really makes sense to continue to buy bonds, put money in the market while they're raising rates. So they're going to do this first, and it's going to scare people a little bit. So be ready for that market reaction. In my mind, I'm a fully invested bear. I think it's still a buying opportunity, but I don't want to buy on day one of the Fed's taper talk. So we want to be patient. You don't need to hit the exact bottom, just like you don't need to hit the exact top. It's like a hand grenade. I learned this in the Army. You do not have to hit your target with a hand grenade. You just got to get close. And believe it or not, you don't even really have to get that close. So don't do a lot of aiming. Just be ready. I want you to be ready. So today we had a question that I didn't answer very well, and I just want to follow up on, and that is the COVID qualified plan withdrawal exemption. And this is kind of a neat thing. It was part of the CARES Act. You can take out without penalty from your IRA or your qualified plan, 403B, anything in that section of the tax code without the 10% penalty. So you can do up to $100,000, and I'm just going to look at some notes that I have written down here. You can take out up to $100,000, and you could pay it back over 3 years if you want to, and it's not taxable to you. There's also no interest on it. Now, if you take the money out and you have no intention to pay it back, there is no penalty, that's true, but it does go to your taxable income. So what I would do is I would probably choose to pay it back and then see how much you do pay back, because it won't be taxable to you right away. So if you choose that you're going to pay it back, you have 3 years to do that. And of course, it's like same as cash. We used to do these when I was younger, married. We didn't have a lot of money. In fact, we had no money. But we would go to a store, buy something same as cash for 12 months. But every month we made a payment on that, so that on month 11, we didn't have a big surprise where we had to come up with a big pile of dough. So I don't want to see you have to do that. So you have 3 years to pay it back. You have no initial penalty. The 10% penalty is waived. It's not taxable if it's paid back. It's taxable if it isn't. And there's no interest. So I really like this. But the call I got today was to buy a house. Now listen, I don't know that I would take the money out to buy a house if I could get a loan. And the reason is mortgage rates, 30-year mortgage, are under 3%. This is free money. Houses are growing at a huge rate right now. Now it's not going to be like that for very long. I think it is going to come back to normal, but it might make sense right now to get a loan for that mortgage if you're able to get the loan. If your credit's good and you have room in your budget, I probably would do that before I took money out. And this is the reason why. There's 2 reasons. One, interest rates are very low, and secondly, the market is growing. And even though we've talked about stagflation today, I think the underlying market is very, very strong. And if you remember, well, you don't remember this because not many of us were alive then. I certainly wasn't. Spanish flu lasted 26 months, disappeared. So there is a possibility that could happen here. I'm hoping that's what happens here. The Delta variant seems to be topping out right now, but we don't know that there isn't going to be something else, or it isn't going to pop up someplace else. We're kind of getting these blooms of virus, these outbreaks of virus in places, and it is affecting the supply chain. It could keep prices higher for longer, but if we do follow the Spanish flu model, we're nearing the end, and I hope we are. Numbers have never been higher than they are right now since the start of the pandemic. There's more people hospitalized, there's more deaths, there's more cases right now than ever before. Now, I didn't blame Donald Trump for this before. I'm not going to blame Joe Biden, even though he's the president right now. I'm not going to blame him for it. It's the virus. It's going to do what viruses do, and people are going to catch it. So I want you to be ready for a fall in the market. I want you to keep some powder dry. We're going to invest when the time is right. And if you're going to do a COVID withdrawal from a qualified plan, call a financial professional, talk to an accountant first. Just make sure it's in your best interest. And even if you don't pay it back, that you'll be able to pay the tax on what you took out, because the tax is going to be due. So I am David Safransky. This is Financial Revelations. We love you guys. We want to hear from you. Reach out, email. You can call. You can find my webpage. My webpage is epsf.com, Echo Papa Sierra Foxtrot.com. You can get us at Financial FI Revelations. We're reachable. I want you to reach out and touch. We want to answer your questions. We love you guys. We'll see you next week.